Hey, everybody, and welcome back to Retirement Redefined. Today, we have two special guests joining us, and I'm going to get back to them in just a second. We're going to be diving into what real estate diversification can mean for you, how adding it into your investments could be something that is worth exploring. And as always, tune in every other week for more retirement info, strategies, topics that are designed to help you make confident decisions about your future. So with that, let's get into it.
We're really excited for this one. Real estate is such an interesting piece of the discussion around diversification. So Skip and Austin are here with us today, and while we won't be talking about any one specific company or project, we will be exploring how real estate can fit into an overall financial strategy.
Skip, Austin, thanks for being here, guys.
Great to be with you.
Happy to be here.
I said this offline before we started recording. The odds that we get everything in this episode that we want to talk about with this group of people are not good. And so we'll try to be as succinct as we possibly can. But Skip and Austin, not only are kind of business, but not partners. I don't know the word I'm looking for right now, but we've done some business together, but more importantly, friends of mine as well. And so just quick introduction, Skip, and Austin, can you just tell us a little bit about yourselves? I know background-wise, you've been in this industry. You've been on my side of the table, helped grow a very significant registered investment advisory firm, or RIA, and exited that. Had a lot of success there. You've done consulting in this industry as well for other independent financial advisors, but currently on this path with a private real estate company called Gratus. And so just kind of seen all aspects of this industry, which is awesome and lends to all the authority needed to be kind of experts in this topic. What I'm more interested in, though, is more the personal side. And so as you introduce yourselves, tell us a little bit about yourselves on the personal side, and then we'll dive in.
I can start. Skip Johnson. I think what you need to know, married to Amy for 17 years. I've got 3 daughters, and they're all about as pretty as my wife, which means I'm in trouble. And we live on the east side of town, some kind of White Bear Lake area, but we're, represent a Minnesota-based private equity firm here in the Twin Cities.
Awesome.
Yeah, and I'm Austin Schmitt. I've been married to my wife, Hannah, for 13 years. We have 2 kids that are a little bit younger, 8 and 6 right now. So I'm learning from everything that Skip has to go through first, and then taking notes on all that stuff. So I've got a girl and a boy, Aspen and Sawyer. Our life is full right now, and Sawyer's finally getting into sports. So we play a lot of t-ball and play a lot of football in the front yard and the backyard. So it's been a blast, and we live in the Twin Cities here in Maple Grove.
Awesome. Thanks for sharing. I remember when my boys were that age and we were in t-ball. I'm just so glad I get to watch real baseball now. T-ball's fun for a lot of reasons, but man, watching fly balls actually be caught and ground balls actually be fielded is also really cool.
Mm-hmm. Yeah. We're looking forward to that day. Right now, we got to get it out of the infield.
Yeah, details, right? And you're also playing on fields that were like, I don't know. They're just they're the fields that they can just find for t-ball. And so there's usually grass growing where there shouldn't be grass and things of that nature.
Exactly.
And the dads who are out there are twisting ankles in the potholes in the fields where the kids are Gumby and it doesn't matter. I just remember thinking, this is not made for old men. So
for sure.
Long story short, I'm past that phase as my boys are grown up. But people aren't here to talk about all of that. I'm glad that they get to know you guys just a little bit. But at the end of the day, when it comes to real estate and it just comes to overall financial planning, not only do you guys understand this real estate world because you're in it, but you've spent a lot of your career actually on the financial planning side. And so it's one thing to understand how real estate works, especially in the private side, but how it fits into an overall financial plan is I think, a really unique perspective that you guys have. And so, Skip, let's start pretty broad here. A lot of investors think kind of in terms of just stocks and bonds, right? In fact, a lot of times you hear the phrase like, oh, you should be in a 60-40 portfolio. And that's just talking, again, stocks and bonds. But real estate is a different asset class that's been around forever. It's a pretty fundamental one. So why do you think real estate should be appealing or continues to be appealing to the average investor, where it might fit into a portfolio?
Yeah. So Brad, guys like you and I have gotten a really interesting spot. We literally had thousands of families where I got to see the end result of where their net worth arrived at age 60 or 70.
Yeah.
And without question, the wealthiest families we served were either business owners or owners of real estate, and often both. Like, period. Maybe we had a professional athlete in there. It was significantly, they owned assets outside of just the stock market, and there's reasons behind it, right? Like, it's tangible, it can, limit volatility, but you look at all of these successful families, and then you look at the wealth management industry was forgetting or not figuring out ways to implement that into a plan, and which saw was a problem that needed to be fixed.
Yeah, I think the interesting part to me in what you said there is it's a tangible asset. It's also a necessity. Yeah. Investing in something that isn't like a fly-by-night like fad is always interesting, right? Like, I would rather invest in something that I know is going to be good long-term. It seems to me, since the beginning of time, shelter has been a pretty important part of the average human being's livelihood. And so it's
kind
appealing
of
to that
hierarchy of needs, right? It's food and shelter and safety.
Yeah.
Pretty good investment to have something or own something that everyone needs.
Yeah, I think there's a ton of appeal for real estate as an investment strategy overall. But Austin, what would you say is kind of the biggest misconception about investing in real estate?
Yeah, there's a ton of misconceptions out there about real estate. And really it comes down to the spectrum of all the ways that you can do real estate. Most people think it's either the big projects are for the wealthy individuals or the big corporations that are buying up a lot of these deals before they even hit the market. And a lot of that is true. And then on the flip side of it, for a normal, everyday person, they think that they need to go buy a townhome and rent it out, or they need to find an Airbnb because their friends are doing it and it's producing a good return. But there's many more options than that you can get into without even swinging a hammer. And that's really where I think it fits inside of a portfolio or inside of a plan under the guidance of a financial advisor. But there's other ways to do it if you know where to look and your advisor's educated on those options.
I think when you talk about misconceptions, you touched on one there I just want to dive into for another minute or two, and that is this idea of having to be a landlord. A lot of people avoid real estate because they don't want another job.
Yep.
And I'm one of those people, by the way. I'm like chiefest, like first hand raised guy, like no way do I want to deal with landlords. I'm very picky about like my house and the way my house is kept. And like my boys, it drives them nuts. I mean, I essentially am a landlord. I have a teenage boy and one that's about ready to be a teenager. And so essentially I have two tenants and they're terrible. They don't keep their room clean. It's a mess all the time. And my son said to me the other day, he's like, why does everything have to be so clean all the time? Why do you care? Which is exactly why I could never own rental property. That being said, a lot of people think that's the only way to invest in real estate is if I want to go buy and be a landlord. So can you talk to me a little bit about options that exist of getting into real estate where it's not what we would deem active? Like you don't actually have to lift a finger relative to being an investor like you are in an Apple stock. Just because you buy Apple stock doesn't mean you're an employee of Apple and they actually expect you to be on campus in Palo Alto and working for the company.
Yep, for sure. So the main two ways to get into it are really in the area of syndications and private real estate funds. Those are the two places that allow for the passive investment and not having to be a tenants and toilets type of person, not have to swing a hammer, but also being closer to the real estate than investing into a publicly traded REIT or something like that. So the dance is trying to find the balance to try to be on the passive side, but still close to the real estate to get the benefits of the real estate. So the two that I mentioned, private real estate funds are just that. There's a company that's going out, they're raising investor capital, and they're purchasing a building or a group of buildings to invest into. They're going to manage it professionally. They're going to run it like a business. but it's still passive for the investors that get into it. Syndications are the exact same thing. It's just one property instead of multiple. So those are really the two ways that people can get into the space on the passive side, have somebody else manage them, but be close enough to the real estate where all the benefits still come to you instead of a corporation taking those.
Awesome. And I know we're going to talk about the benefits a little bit more later, so we'll kind of pause on that for now. Diversification. So we talk about diversification a lot. When it comes to stocks, you don't want to buy all one stock, right? You want to, from a real estate perspective, though, especially if you're the person that doesn't have millions of dollars to dump in real estate, you want it to be part of your portfolio. So maybe it's just, maybe it's 10 grand, maybe it's 100 grand, maybe it's even $1 million. Like, you can't go out and buy a bunch of property with that amount of money, right? And so how do we get the diversification that we want when we don't have $50 million to go to deploy across a massive spectrum of real estate?
Yeah, I think, there's diversification or asset allocation, stocks, bonds, whatever, as much as I like our deals, a product is not a plan, right? But there's diversification amongst asset classes, like maybe you own some real estate and stocks, bonds, mutual funds, and annuity, whatever. But on that, the problem with a rental property across the street from your house is if my tenant moves out, I have 100% vacancy, like zero occupancy on footing the bill. If I have a duplex, now it's, 50%, get a fourplex and eightplex. The kind of properties that we deal with, we're talking 100-unit type apartments. You typically budget at any point that we're going to have 5% or so of those units empty. And that's just built into the pro forma or the modeling. So one person moves out, we're like, cool, budgeted for that. That's part of the plan. We've got a leasing team ready to lease up the next one. So that's one property. You can also get diversification, I would say, amongst locations. You could have multiple properties, multiple locations, multiple cities, multiple states. And then, if you get really good tailwinds in one market, you might have one that's not doing quite as well, but the diversification should help your blended, average do well. So bigger properties just make it easier. It's just historically it was harder for the individual to participate, as you mentioned, Brad.
Yeah, I think that's really interesting to think about kind of diversification by asset type or property type. But what about diversification by strategy? Things like buy and hold rentals, short-term vacation rentals, or development projects. What do you think about that, Austin?
Yeah. I think there's a little bit of a need for all of them at some level, depending on your appetite. So I have personally invested in multiple areas and different strategies of real estate. And they all were for different reasons, but I was aware of why I was doing each one, which I think is important. So you can do things like new development where you partner with a developer or you get a group of investors to partner with a developer. That is one way of doing it where you're delaying some of that cash flow that real estate generates, but you get a higher equity pop because you're taking a piece of land that has nothing on it and adding value. It's essentially the ultimate value add play. So that's one way of doing it. Airbnbs are great. They provide tremendous cash on cash return. You can really do well on a month to month or a quarter to quarter basis. But man, I will tell you, I sold one about a month ago because I was so sick of being there and super active in it. And getting those calls Skip has a great story about this, but getting those calls at 2:00 in the morning that something isn't working or that the fire alarm's going off and you have to respond within a certain period of time, otherwise you're going to get penalized. Man, I don't want to deal with it anymore. It was a great investment. If you have the time and the capacity to do it, it's great, but it's probably not for everyone. And I found out that it wasn't for me, even though I dreamt about it for a long time. And long-term rentals are kind of sitting in the middle. If you buy a townhome or a single family or something like that and rent it out, a little bit in between on the cash flow side, but you're still an active landlord. And so unless you're going to outsource that and have the volume to outsource it, it gets to be pretty draining on the amount of time that you have with your friends and family and the things that you actually want to be spending your time doing.
I think one of the things hopefully the listeners are picking up on here is it sounds like you're starting to exit that active game, if not fully exited at this point. I made the comment that I have no desire to get into that because I already have 2 tenants that talk back to me all the time. There are ways to be passive. There are ways to get into real estate, to bring diversification, and to come in on the passive side. Now, that being said, those are some of the pros, if you will, of getting into real estate, but there's also, and there's upside, right? There's positives, but there's also risks. So Austin, what are a couple of the risks that investors might not see coming?
Yeah, totally. Well, Skip already mentioned one of the main ones. Vacancies are a pretty large risk that you have to account for. Again, when you're spreading that out over multiple units in these larger properties, you can pretty much predict that you're going to be 5-10% vacant at any given time. But what if there was a pretty heavy economic shift or a legislative shift that happens? And we saw this really powerfully in Minneapolis, where people were moving out of the urban core areas because COVID happened and work from home was a thing now. The urban environments weren't as safe as they once were. And so people moved from those urban cores to the suburbs. And so when you are looking at properties, it's not only knowing where do you want to be today, but where are the trends going, where are the shifts happening that you need to account for so that you can go where the puck is going, not where it is today. And then just budgeting. I mean, you have to know the property. You have to know how you're going to maintain it, the reserves to set aside, et cetera. And so it's something you need to plan for. But those are some of the main risks I would see right now.
And Skip, you talked a little bit about how diversification can minimize some of that risk. Is there anything else you should add to that conversation?
The old adage, location, location, location.
Yeah.
With real estate, they're not making anymore. We try to find the best property, or the best locations, and we tend to work in secondary markets, tertiary markets, meaning I don't care if it's sexy. I want steady, stable, good economy, favorable regulations. When it comes to our long-term wealth, I don't care if it's sexy. I want it to make me money. So location, location, location is an adage because it's true.
Yeah, thanks for that. So if we kind of take a step back and say, okay, you've evaluated pros and cons, you've maybe found a real estate investment, you are interested in investing, Skip, how do you see that real estate investment working alongside a more traditional investments of stocks and bonds and a, traditional investment portfolio?
Well, first of all, evaluate it overall in a plan. I'd want to know what's the purpose, right? Is this a long-term accumulation play? Do I need income to support my lifestyle now? Obviously, real estate, another risk is it's not super liquid, meaning if I want to sell my house tomorrow, you're probably going to have to sell it cheap. So you should fit and understand the attributes and how that's going to support my dreams, goals, desires. On that, then it's where do you pull the money from? Does this make sense in an IRA or a Roth? Should it be my non-IRA money? There's different tax benefits to that. And then you've got to ask that question, are you the handy person or not? I grew up in a family, if you couldn't fix it with duct tape and a swear word, you weren't going to fix it. So, ripping out a floor or doing new, plumbing was not our thing. So on that, as you evaluate what type of investment do I want, it can be a misconception that, active rentals pay more, maybe, but you also had a part-time job. And I know Fiat works with a lot of people in or nearing retirement. And if you're looking to spend more time with your family and your friends, do you want active or passive? Those are all choices. I think one thing I love about an independent group like you guys is you don't shy away from those conversations. You have people across the spectrum and just help them fit which one rather than, some advisors just don't talk about this because they don't know how to get paid on it. And that's a conflict of interest that I think is worth having those real combos the way you guys do.
Yeah, great point. I would love to, when you just think about if you're listening, the listeners, and they're thinking, gosh, I've never maybe I have invested in real estate, but it was on the active side and I had a bad experience. And so I just kind of wrote off real estate. Or maybe it's people that have just never invested in real estate ever and weren't aware of this idea or concept of investing passively and having access to it without having to dump millions of dollars in. When you start to think about where do you start? Like if for the listeners, Austin, what would be kind of your number one piece of advice or kind of the first step as it relates to thinking about the possibility of investing in real estate?
Yeah, I think it really comes down to starting in three different spots. It's the risk that you're willing to take. There are the tangible risks financially, but there's also the can you go to sleep at night risk. And so what is the risk that you're willing to take to just be able to be satisfied with where that money is and what it's going to take from you to be able to maintain that. So the risk tolerance that you have, Skip mentioned it, but timeline is huge. I mean, you're talking about projects that if they're larger projects, you're talking about projects that take a year, 2 years to build and probably almost a year to sell if you were going to need to get out of it. So you're talking about things that people are living in. You have to kick tenants out or you have to sell it to a larger group. The timeline of which you need the return or you need liquidity is massive. And that only comes with knowing where it fits inside of the plan. And then really, how much capital do you want to put into something like this? There are deals out there where you need $250,000 or $500,000 to have access to it. Most people, that's not a smart play. And that's over leveraging that part of their portfolio. But also, you don't want it to be such a small amount of your portfolio where it doesn't make any difference. It doesn't smooth out the volatility that we're talking about. It doesn't get the tax benefits that you need. So you have to figure out, what is my risk tolerance emotionally and financially? What's my timeline that I need the money? And then what's the appropriate amount of capital that I should be investing into this asset class? So those are the three that I think about.
Yeah. Carly, this question, I got a question for both Skip and Carly now, because Carly coming from the tax side of the house, because we alluded to this earlier, and I want to make sure that we get this out to the listeners, because every investment on the face of the planet, you guys have pros and cons, right? And one of the things you've discussed, Austin, and Skip, you alluded to as well, was illiquidity, right? This isn't like Apple stock where I can just go sell it immediately. I just push the sell button and magically there's a buyer on the other side that just takes my stock from me, which I think is lost on a lot of people, how liquid that money actually is. The fact that when you choose to sell Apple stock, it just sells like immediately. It just doesn't sell into the ether. Like there's actually a buyer on the other side, but because there's so many sellers and so many buyers, we just get so used to this and kind of forget the idea that there's somebody else on the other side of that transaction. When it comes to real estate in your personal house, it's different. In fact, the home across the street from me has been for sale for 4 months. So if you want to move to Delano, Minnesota, and you've got a nice family and you're great neighbors and you're going to take care of your yard, I'd love to have you. But it's been for sale for 4 months and now they've dropped the price twice on it. It's just less liquid. But the other thing we talked about on the positive side is this possibility of tax advantages, because we talked about the spectrum of real estate and kind of alluded to this idea of getting to the passive side so that you don't have another job, but staying close enough to it that you still get access to some of the tax advantages. So my question for Skip and for Carly is, one, Skip, can you talk a little bit about what that means to be close enough to it? And then from a planning perspective, Carly, just talk a little bit about how that can, in a positive way, possibly affect an overall plan and investment allocation.
Mm-hmm.
Yeah, the tax code is a series of incentives. If we follow the bouncing ball, we can find out what does the government incentivize, and employing people, building infrastructure, housing, real estate are all up there. So there are tax advantages attached to an asset like owning an apartment building. We have what are called depreciation schedules. There's bonus depreciation. The One Big Beautiful Bill Act, shifted some of that. So where you own that, like if that's in an IRA or a Roth versus non-IRA, that affects you. And how that fits the rest of your assets. Do you have other passive income? But that's for Carly and the team to help solve and settle. Yeah. I will say there are significant advantages tied to real estate with that. However, We didn't mention this earlier, which is probably my fault, but REITs, real estate investment trust, is a common way that in kind of a retail, packaged way, a lot of people own real estate, but you actually don't own real estate through a REIT. You own shares of a corporation through a REIT, which means you're at like corporate tax rates. You don't get the depreciation that flows through. So kind of that spot that, the firm we work with sits is the partners own it. They get a K-1 that comes to them. And depending on the plan, and obviously I defer to a team like yours, like there's advantages or tax benefits, which is just different than a REIT and different than, owning something in an IRA or whatnot.
Yeah. And I know, Carly, I threw a pretty big question at you, and so I'll just reiterate it again, because I think we could need to stay at a 50,000 foot kind of conversation for this podcast. But just from a CPA's perspective, like what Skip's talking about, this idea of like, he used the word depreciation as an example. From a tax perspective, owning real estate, what are some of the advantages possibly to an investor?
Yeah. So maybe I'll just say really quickly that depreciation is this idea of being able to write off the cost of the real estate itself over time. And depending on the type of property, that can change the length of time that you get to write that off. But it's a non-cash transaction, so it's not actually an expense that hits the bank account. And it directly offsets kind of the rental income that property receives. So it gives you a tax benefit that isn't directly tied to cash. That's the benefit there. There's a lot of strategies that we can implement within real estate, but it really does matter, what type of investment you have and how actively you're involved in that project. So, Skip, I think you said earlier, like we don't really have this cookie cutter approach to all of our clients. We have clients that are all along the spectrum. So I have, doctors and dentists and veterinarians who own commercial real estate, the building that their practices are in. I've got people that own residential real estate, people that have short-term rentals, and then we have people that are involved in like limited partnerships and real estate investments, and we also have REITs. So there's a huge spectrum of tax implications, not only for how your income is taxed when you receive it, but also like what your options are when you sell down the road. And so that's a big piece of the planning that we do on the Fiat team, is the wealth management side and the tax side kind of working together to say, hey, let's make sure we understand the tax consequences for the income you're receiving today as you're earning it from these rental properties. But then also, what do we do if we're going to sell, and how do we divest of those properties? How can we avoid some of the tax implications down the road? So we're looking at both when we're doing planning with our clients.
Love it. That was that was pretty detailed in a pretty short amount of time. That was impressive.
That was good.
We're getting a little short on time, and we could talk about this for a long, long time. And so I kind of want to wrap with this at a high level, Carly, just trying to bring to light what you were talking about from a planning perspective. And every investment decision you make has a tax implication, like everyone, whether you're choosing how to invest into your 401k, or you're choosing how you're going to spend your assets in retirement, or you're choosing whether to invest in real estate or not invest in real estate. There's tax impact to all of this. The thing with real estate, if owned properly, and you're close enough to it, to use Skip's language, you can use it to try to smooth out your tax liabilities. At the end of the day, whether you depreciate it, if you depreciate out an asset, as we've been talking about, eventually that's going to come back to you when you go to sell it. But it allows you tax control and where to kind of put taxes into your 1040 from a timing perspective. And for a lot of families, that's really important part of the planning process. And there's just not a lot of assets that you can invest in that allow you some of that tax flexibility from a timing perspective. And real estate is just one of those things. And so some of the other things we talked about, it's kind of a fundamental, Skip, is it Maslow's hierarchy of needs you mentioned earlier, right? Pretty fundamental part of an overall need for people. So from an investment perspective, obviously, we anticipate people are going to continue to need real estate and shelter. That can be a big positive. It can be a big positive from a tax perspective. Overall returns in private markets, you would expect better returns than public markets. Otherwise, why take the additional risk? Why take the limited liquidity and things of that nature? And so there's obviously drawbacks to this, but at the end of the day, it just comes down to planning what makes sense for your family. And so whether it's working with a firm like Fiat that then is partnering with a local real estate company like Gratus and Skip and Austin and their team, or it's getting into bigger things like REITs or just being an active landlord because you want to get into the Airbnb market, understanding the pros and cons of that decision and how to utilize that investment to the best of its abilities, not only to your overall plan, but from the tax efficiency that may come with that, is important. And at the end of the day, that's why inside of kind of the Fiat team, not only do we have great people like Carly that actually are on staff and are here, but we also have great partners like Skip and Austin at Gratus that help us understand the impacts for the families that we serve. And so you guys, I know that you're both really busy, not just only in your professional lives, but in your personal lives as well. So it means a lot to Carly and I that you took the time to kind of be here on an episode for us and kind of bring to light maybe some of the possibilities that might be out there for families. So thanks for joining us, guys.
Thanks for having us.
Glad to be with you.
Yeah, thanks for being here. And for our listeners, just be sure to subscribe to Retirement Redefined and join us every other week for more conversations on retirement strategies and financial planning.
Thank you for listening. Don't forget to click the subscribe button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views and opinions of Fiat Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.